Good afternoon, everybody. It's great to see everybody. I appreciate you guys being patient with me moving the time of this webinar. As much as I love option trading, I love the Cubs more than I love option trading, and they're probably going to lose. But you know, I've got to stick to. I got to follow them along. You know, I'm like one of the lemmings jumping over the cliff with my team. You know. All right. So, exactly. So, let's talk about a reminder that this is for educational purposes only. None of this should be considered investment advice. Options have risk. Consult your financial professional. If you lose money off of anything we discuss, it is your fault. I am Mark Sebastian. I am the founder of OptionPit.com. Hopefully you guys know who I am. But for those of you that is your first webinar with us, we are an option education and consulting firm. We work with hedge funds and money managers and prop shops, helping them implement option strategies, stress test option strategies, and manage option strategies. On the retail side, we try to teach traders the same way we were taught. So when I was 22, I started in an option training program at Group 1. They spent a bunch of time teaching me how to trade, and I became a trader. In addition to running Option Pit, we actually do manage a private hedge fund. So what are we going to talk about? We're going to talk about what is volatility, what is VIX, and ways to trade VIX. Should be a lot of fun. Volatility. Volatility is a measurement of movement of an underlying instrument over a period of time regardless of direction. The higher the volatility, the higher the movement and or expected movement of the underlying. So when I discuss volatility, all right, especially within options in trading, okay, I am always talking about the number as an annualized number. So if I pull up Apple volatility and it says Apple volatility is 18, that is an annualized number. Apple is going to move 18% annually. That's the way options are pricing things. So, you know, that's really the first key. All right, to understand is that volatility is a number that, you know, we look at, but it's annualized. It's not over the life of the contract. There are three main types of volatility traders look at. Historical volatility. That's how much an underlying has moved in the past over a set number of days. We can look at 10, 20, 30, 100, 600-day volatility. Then there's realized volatility. That's how much the underlying is actually moving right now. So what is Apple doing today out of earnings? What is the volatility of Apple today? What is the volatility of Tesla? Now that what is the volatility of Tesla on its earnings? All right, how much is it moving? Currently, it's up 11. For those of you that care. Then there is implied volatility. So if it's up 11 and it's a $200 stock, it's moving 5% a day. We would take that 5% and annualize it. That's a huge one-day annualized move. Then there's implied volatility. Implied volatility is how much the market is expecting the underlying to move over a future set period of time. Typically through the expiration of the contract. So options, things like VIX that we're talking about, are measures of, they're all measures of implied volatility. So what makes trading a stock different than trading volatility? Over the long term, we know where implied volatility of a stock or index is going to go. We do not know where the stock price is going to go. Implied volatility is mean reverting. And here's just a quick, here's Apple stock. and here's Apple volatility. And what I want you to notice is that 200-day moving average is pretty flat, and that 50-day moving average chops around. All right, if I pulled this since I took my latest picture, it would look even better. Volatility has a mean reverting quality. Isn't it true that the VIX is based more on the price of options rather than movement? That is correct. It is based on implied volatility, which is derived from the price of options. All right. So the thing to remember is a stock price can go anywhere and stay there. While volatility can go anywhere, it cannot stay here. Stay there. It will revert back. Understanding this will help you with your buying and selling decisions. So here's a question. The anniversary of Black Monday was a few weeks back. It was on the 19th. Anybody know what after the fact they think VIX, the volatility index, went to? Yeah, over 150%. The VIX went to 150. The highest since it became kind of more measurable is about 87. Since they actually started quoting it. All right. Now, volatility can stay low for a very long time. All right, if you think about the VIX having the average VIX being around 17 and a half. All right, how many occurrences? All right, so let's say, or Apple, right? Apple had a huge implied volatility yesterday of like 40, and now it's got a volatility of 18, and over time its volatility is 22. Well, how many days of 18% implied volatility do we need to make up for 1 day of implied volatility of 40? A lot. All right? A lot. So the thing to understand is that, yes, volatility is mean reverting, but there are a lot more days where volatility is below its mean than above. There are a lot more days where volatility is below its mean than above. So most traders think mean reversion is an instantaneous thing. It's not. Like I said, vol can stay low for long periods of time. 2012 through 2014 and a half, volatility was in the toilet. We saw it get sky high in August and then stay high all the way through February. August a year ago, volatility got into the 50s, and then it stayed pretty much elevated through February. Now, since then, volatility's been in the toilet. All right? So, it's important not to have a recency bias. Understand how high volatility can get and how low volatility can get. All right? And don't just assume that because the VIX is 12 that it won't be 12 tomorrow. All right? When IV is low, it can stay there for a long time. Money can seem easy to make. It can seem really easy to make money selling premium. All right? And this is because volatility correlates to itself. Volatility does have momentum. So a day of low volatility begets the next day of low volatility until that no longer is the case. That's an important thing to be aware of. All right. Money can go away incredibly fast, though. All right. So when vol is really low, the play can be to be long volatility, long units, and short premium. Things like calendar spreads and modified flies. Some things that we do in Option Pit. So what about high vol? When IV is high, it will fall back. Until kind of the last, up through 2015, IV spikes had been 1 and 2 day events. Now they've seemed to be more like 2 and 3 week events. IV can stay high for months and then take months to ease back. Things like long VXX and short time spreads can be the right trade. Short butterflies can work. Things that are short wings. There's all sorts of trades that can be profitable. So just be aware that volatility, all right, volatility is its own animal. So now let's talk about VIX. The VIX is the CBOE Volatility Index. The purpose of the index is to gauge the buying and selling of options in the S&P 500. So the VIX gauges the cost of insurance. The idea is that when there's more buying over selling of options, generally speaking, the market is trying to buy protection. When there's more selling than buying, the market is not out seeking protection. Thus, when VIX is up, the cost of insurance is higher, and vice versa. All right? VIX up, it costs more money to hedge a portfolio. VIX down, it's cheaper to hedge a portfolio. That is what VIX is. So similar to the S&P 500, the index is not actually traded. There's no way to trade VIX. However, unlike the S&P 500, all right, you can't even create a basket to recreate VIX. All right, you can't go in and call your broker and say, I want to buy one S&P 500. You can buy SPY, you can buy an S&P future, but you can't just go out and buy the S&P 500. What's more fascinating is that you can't even recreate VIX. There's no way. So there's no way to trade a basket of VIX and create something that will track VIX. So the VIX is essentially an estimate of implied volatility on S&P 500 options that has a constant net duration of 30 days. Constant duration means that it attempts to constantly mimic a portfolio with 30 days to expiration. So a VIX portfolio always has an expiration of 30 days. Always. The weighting of the VIX puts more emphasis on puts, puts more emphasis on at-the-money option than those that are out of the money. So at-the-money options have more weighting in VIX than out-of-the-money options. Now, the weighting of the VIX also naturally puts more emphasis on out-of-the-money puts than it does out-of-the-money calls. It uses more weight on out-of-the-money puts than out-of-the-money calls. And this is because an out-of-the-money put that is $50 away from the underlying, all right, is going to cost more than an out-of-the-money call that is $50 from the underlying. VIX measures premium levels. All right. So the VIX uses the 2 weekly options closest to 30 days to expiration. One is equal to or less than 30 days, and the other one is more. So take a look at this, all right? You can see, so this is an old picture, but at the time of this picture, The VIX used the calculation of that OCT4 contract that had 30 days to expire and the OCT5 contract that had 37 days to expire. And in fact, it was almost entirely the OCT4 contract. Now, there is a calculation you'd be aware of called VIX Mo. And VIX Mo is what standard futures expire into. It's the VRO, the VIX opening rotation, when futures expire, and we'll talk about this in a little bit, is based on VIX Mo. And that is based off of the old VIX calculation, which used the front 2 months instead of 2 weekly contracts. Now, the VIX is quoted as a price, but it is actually a percentage. It's a volatility. So a VIX of 30 is actually 30% annualized volatility. It is 30% annualized expected movement over the next 30 days. So over the next 30 days, the market is looking for an annualized volatility of 30 days. All right. So that's the thing to remember. So here is an old, what do you notice? So the blue line is the S&P 500 and the red line is the VIX. What do you notice? Yeah, they are negatively correlated. Negatively correlated. So the VIX negatively correlates to the S&P 500. Generally speaking, when the S&P is up, VIX is down. When SPX is down, VIX is up. It makes sense as generally the market sells off, volatility does increase. There's also the nature of similar movement against a lower number. So think about this. If the S&P is moving $15 a day and if the S&P is moving $50 a day and it's trading 1,000, that's a daily movement of 5%. If the S&P is moving $50 a day and it's trading 2,500, that's a daily movement of 2%. Those are entirely different volatilities. All right, so this is good. Clarification, 30% annualized expected movement over 30 days means roughly 2.5% move over the next 30 days, correct? A 30% annualized volatility over 30 days is basically looking for a little under 2% movement a day. So 2% movement a day. If you want to look at the daily movement, take that annualized number, take the VIX, and our back of the envelope calculation is to divide it by 16. All right? Yeah, it's standard deviation. So if you take that annualized number and you divide it by 16, that is your daily movement that the market is looking for. So right now the VIX is 16. If the VIX is 16, it's not 16, but if right now the VIX is 16, then basically the market is looking for a 1% move a day. All right? So yeah, the key is use that back of the envelope calculation and divide it by 16. So the construction of the VIX also naturally causes it to rally when the market falls and fall with the market rallies. And this is also caused by skew. Remember, the weighting of the VIX puts more emphasis on at the money. So if my at the money is right here, all right, that's going to have the most weighting. Well, even if volatility doesn't increase and the underlying falls to, let's say, here, what's going to happen to my VIX, even though volatility itself didn't really move? it's going to go up because it's putting more emphasis on that at-the-money option. All right, so now let's talk about VIX options and futures. VIX options and futures are a European exercise. This means there is no early assignment. They have a unique settlement procedure, all right? All right, and it's based on VIX-MO, not the VIX itself. It's a VRO. At 30 days to expiration, typically VIX will move with a beta of about 0.5 to VIX. As time passes, beta increases. All right, so now VIX futures are the most successful product introduced in the last 20 years. They trade out about 8 months each, and they have weeklies. Each month trades independently, not like the structure of SPX. All right, there is a direct relationship of an S&P 500 December future to a March future to a June future to December 2017 future. It's entirely based on carrying cost. All right, it has weekly futures, but they trade lightly. It is in what's called a contango 80% of the time. What is contango? Contango means that the VIX future is trading higher than cash, and the front month VIX future is trading less than the second month future, which is trading less than the back month future. All right, I can show you what contango looks like. If you haven't been to VIX Central before, check it out. It's one of my favorite sites. This is what today's curve looks like. Here's November, December, January. Now, here's what it looks like with all the weeklies. All right. The weeklies can move around a little bit. So generally speaking, I just look at the big contracts, the trade. VIX futures are used primarily as hedges, but there are a lot of people that do like day trading them and actively trading them. There are also a lot of funds that try to capture volatility. All right. Now, VIX options are the most successful product introduced in the last 20 years too. They trade out 8 months. Each month trades independently, not like SPX. It has weekly options that are traded actively. So whereas VIX futures can trade sparingly, VIX weekly options are really active. And remember, the underlying for VIX options is the future, not the VIX cash. And these are absolutely used. All the big trades in VIX options tend to be hedges. Although, again, there are funds that go in and trade these to be short. And they're typically a hedge against a long portfolio when they're put on. And I'm going to show you how the big money hedges and how, this can actually work for a standard portfolio. I'm going to give you the system. VIX options are extremely liquid. They trade over hybrid and open outcry. I do almost all my trading open outcry. Markets are tight. They're almost always a nickel wide, dime at the most. They don't trade in pennies. They're not penny traders. Spreads trade in pennies. All right, you can trade spreads in pennies, but you can't trade the standard options in pennies. So take a look here, and here's a trade. I'm going to actually show you what this guy was doing. This 139. Let me erase that. So this trade, I'm actually going to show you what this guy was doing. All right, but you can see this thing trades in bulk for size. Massively for size. This is a slow day today, and it traded 350,000 contracts at that point. Average volume, about 530,000. Average open interest, about 6.5 million. And notice calls far outpace puts. Current open interest is about 3.2 to 1. So recall that VIX options, the at-the-money strike is not the VIX cash level, but is the futures. So today, when I did this at like 1:45 my time, at the money for November was the 15.5 strike. At the money for December was the 16.5 strike. And at the money for January was either the 17.5 or 18 strike, depending on where you wanted to trade. So they have different at the money. All right. Question: if VIX is a 30-day measure, why are you talking about annualized? Because VIX is an annualized number over the next 30 days. And yes, we use 16, not 19. Generally VIX is calculated off trading days, not calendar days. So here is VVIX. What is VVIX? VVIX is the VIX of VIX, and it is a measure of VIX's implied volatility of its options. And what I want you to notice, this is a one-year chart. Over the last year, 80's been pretty much a line in the sand, and 110 has really been a line in the sand. Even back in the junk in December and January, that was high. So when I'm setting up trades in using VIX options, I'm looking at this to figure out whether I want to go long or short. When using, all right, so trading from the long side. When using options to trade a higher VIX, typically the most favorable call is one that is slightly out of the money or at the money. And then buying that call is at the money, and buying that call that is at the money, and then selling it out of the money. If you're just doing a straight vertical, you want to be long a call spread. Long call spreads are way better than trying to do like a put credit spread. All right. But now let's talk about my bullish trade that is kind of a professional trade. So the big trade most traders use is called a back spread. Back spread is when I'm short one option close to the money and I'm long two options out of the money, or three options. Generally, I set these up about 5 points wide, 6 points wide if I want to go further out. It's done with 60 days to expiration. And typically, if it's set up as a hedge, I exit after non-farm payrolls the month of expiration. And these are especially good when VVIX is at the low range. So when VVIX is down in here, I like these back spreads. When it's up in here, no thanks. So this is a trade I might do now, the December 2025 call 1 by 2. And I'd pay a nickel for this. And the idea being that if volatility explodes, this will benefit. And this will hedge me through the elections, through November non-farm payrolls, through December non-farm payrolls. Then it will probably stop working. This is a good question. How do you get to choose open outcry over electronic when you send your order in the trading platform? See, that's one of the nice things about running a fund is I'm able to, I'm able to set up an over-the-counter, the ability to call a desk. And those of you with really big accounts, there are ways to set that up. You can reach out to me if you want to know. But, when I'm trading, I'm typically trading 1,000 to 5,000 contracts at once. It's not over the counter. It's done on the floor. It's just done open outcry. So this is kind of what that trade looks like. And what I want you to notice is that really by kind of the end of November, early December, you start to lose that curvature, that hedge. And so you really want to get out by December non-farm payrolls. But early on, if we get a pop in volatility, it does a great job hedging. Trading short. The further out of the money the put is, the lower the implied volatility. Owning a long put will have favorable characteristics in a falling and or stable environment. Long puts that are in the money relative to cash, but out of the money relative to futures have a great expected value. So like here's a trade that I would have done at, this was at 145 again. All right, I liked buying the November 15 put for 95 cents. And you can see the cash VIX is 1454 and the November future is 1555. And I'm buying the 15 put for 95 cents. Well, what's great about that is it's 45 cents in the money and I'm only paying 95 cents for it. All right, and it's a nice trade. It works. So, for instance, by the end of the day, my 15 put was still 90 cents. Future moved around a little bit. The November future ended up 1561 as opposed to 1555. So this is a play that I really like as a way of playing volatility falling. And when the market's in a contango. All right, now let's talk about these volatility ETNs everyone likes to trade. As trading in the VIX Futures has become more and more actively traded, each of these volatility ETPs has a stated purpose. However, due to the term structure of VIX Futures, many don't do what you expect. They're great intraday, so within the day, but not over time. So they have what I call the Sisyphean Effect. So King Sisyphus was made to endlessly roll a huge boulder up a steep hill that maddeningly, all right, fell every night. All right, and then he had to push it back up. All right, and it was because Sisyphus had the hubristic belief that his cleverness surpassed that of Zeus himself. Zeus accordingly displayed his own cleverness by enchanting the boulder to roll away from King Sisyphus before he reached the top, which ended up consigning Sisyphus to an eternity of useless efforts and unending frustration. Thus, pointless or interminable activities are called Sisyphean. which brings us to VXX. VXX, or the iPath S&P 500 short-term futures ETN, attempts to replicate being long a VIX future with a constant duration of 30 days. Sounds great. Intent of the fund is to allow traders to get long or short near-dated forward volatility. It does that well. The fund does this by constantly rolling out of front-month futures and into the second-month future. Well, here's the problem with that. If I buy a June future for $16.10 and eventually it's getting to $15.50, how's my business going to work out? Right? So if VIX stays 1568, every day this is going to be dropping. So think about that 1610 purchase sliding down the curve. Every day for something I sold, I bought for 1610, I'm selling it at a lower and lower and lower price. That creates the problems with VXX, which creates this. And it's gotten worse. But VXX is awful. It's slowly rolling itself towards zero. It should not be held for more than a few hours if futures are in contango, a day or two. It's a good volatility day trading product, and it can be used as a great hedge against falling volatility, but it's a poor hedging instrument against rising volatility. Now here's some other ones. You've got VXZ. It is the midterm, and it has options. VXX has options. UVXY is the double long, and it's levered daily, and it's optionable, and it is a disaster. You've got TVIX, which is the double long levered. It's a mess. And XVZ is probably the best of the bunch, but it doesn't trade very much and doesn't have options. Now, then there's the inverse ETNs that are theoretically going to infinity, but they have a daily tracking issue that causes them to underperform being short the actual vol ETNs. So XIV is the reverse of VXX, ZIV is the reverse of VXZ, SVXY is similar to XIV, but has options. But here's the part I want you to notice. Look at the ETN returns since 6/30 of 2014. Now, what is 6/30 of 2014? That's about the high of, that's the last time XIV hit an all-time high. So you can see that if you were long XIV over the last 2.5 years, you've lost money on the short ETNs, and you've lost copious amounts of money on the long ETNs. The only one that hasn't gotten completely murdered, that is kind of has long exposure, is XVZ. XVZ does have long exposure. It tends to go up when vol goes up. I'm aware. Would it ever make sense to buy a put on long ETNs? Yes, I do that all the time. That is one way that I trade these things. All right. So in summary, VIX options have unique characteristics. Each has their own underlying. IV and VX and VIX are correlated. SPX and VIX are correlated. Bear and bull plays have different structures. So now let me tell you about what we're doing on November 5th. That's a Saturday. All right, starting at 8:30 in the morning. For $197, we're going to be doing a 3+ hour live online training delving deep into volatility and VIX. You're going to understand how to trade volatility and options. We're going to master hedging and directional trading of VIX. We're going to dig deep into the VIX ETPs like VXX and UVXY. And I'm going to show you some professional techniques I use. You can sell calls. There's all sorts of different ways to do it. This class is going to be awesome. All right. This class is going to be awesome. All right. We've done the last one we did a year ago. People were raving about. It's been 13 months since we've done one of these, and it's going to be updated and really strong. It's $197, but if you use code CANDLE70, all right, through Sunday, it'll take $70 off, so only $127. Go to optionpit.com/VIX Primer. So if you learned a couple of things in this, this is free. Imagine what I'm going to teach you on one of these paid things. All right? People are always wowed by what we bring. I've got about 75 seats left. I can only fit 200. All right, so, and you know, so it's going to be Saturday, November 5th from 9:30 Eastern until we finish, which will be between 1 and 1:30. You go to optionpit.com/VIX Primer. Any questions? Go Cubs. Any questions? It will be recorded, and the recording will be available. This recording will be available tonight. It's going to be in the middle of the VIX Primer page, and it will be recorded, and you get to keep the recording and the materials. Is this the one? What was the question? Is this the one of your courses on the eStore tab? You know what? This is going to be new. This will actually replace the one on the eStore tab. The one on November 5th will be recorded and archived. I've been using UVXY a lot. Question was, any favorites trading now for the future of uncertain swings crazy like this market? UVXY is great. This is going to replace the VIX Futures and Options course. That's $297. So yeah, when this goes back into our store, it's going to be available at $297. All right. How do we purchase if you purchase your CD course? Shoot me an email. Can you make a decent income trading these strategies with $25,000? You know, we run our strategy letter as if it's a $15,000 account, and it is after, you know, after estimated commissions up about 30% on the year. How do you manage your back spread when it goes in your favor? What's the profit target? You know, you manage it as it goes up. I'm typically, if I pay even money, I start taking it off when it gets, I take a little bit off at 50 cents and then a bigger chunk out at $1 and then let it run from there. What do you mean when you call UVXY a disaster? I mean, that thing is great to trade, but it is a mess if you're long it. How about if we have purchased your CD course? So if you've already bought the course, yeah, I can give you a discount. I have extensive but limited experience in VIX. All right, well, you'll get a ton out of this class then. I'll tell you, people that take this class, they're wowed, and this is a class that I really think will make you money day one. What kind of guarantee? I guarantee if you're unhappy with the course, I will rectify the situation. Let's just put it that way. Correct. This one's going to be $297 when it goes back in the store. Right now, if you wanted to buy the recording of this, it would be $247. So you're getting a live course for less than the recording. I consider 30% on $15,000 very good, especially considering the standard deviation of the portfolio. And that's one thing you have to take into consideration is what's the standard deviation. Because 30% on $15,000 where you have huge swings, is maybe not great, but a consistent 30% with low swings. Is there some uniform pricing available? Tell you what, shoot me an email or give me a call and we can talk about it. On the year. So since the beginning of the year. What type of daily swing? Is it? You know, yeah, I mean, you shouldn't have, the problem is daily swings, there can be weird marks that throw things off, but we have a relatively low volatility returns on a month-to-month basis. And yes, they will be archived. You can't use Bollinger Bands for UVXY or VIX unless you're looking at SPY. UVX, I mean, especially VIX. No VIX trading experience, can I understand the course? Yes. If you understood this, this is a great precursor to that. What happens when I become ultra grumpy because the Cubs don't come through in the series? You don't want to know. I have your boot camp. Do I contact you as well? Yeah, give me a call. Give us a call on the 800 number when I log off here, and you and I can chat. I am very knowledgeable, and I'd love for you to learn from me. Can you trade the strategy if you only watch the markets for an hour or less? I mean, I think that's the key, right? Trade the open, trade the close, and then be done for the day. Or put on strategies that can be done for the day. Yeah, we're going to send out the recording tonight. All right. Any other questions, comments, thoughts? Take advantage of this course. I mean it. It's going to be pretty awesome.